Hi guys, thanks for logging in and watching this video. We are going to talk about what's going on in the real estate market. We're also going to have a discussion about the state of the economy because the new consumer price index was just released for August. And boy, I tell you what, there's some shocking details. We're going to talk about our jobs, what's going on. We've seen some major company layoffs, and a lot of people think that it's going to continue. We're going to talk a little bit about the commercial rents and how 40% of businesses polled are delinquent in paying their rent. Let's dive in. If you didn't catch our Tuesday night podcast, we talked about how the housing market has been slowing all across the country. For the last 3-4 months, we've been seeing a slowdown. Now it's almost to a halt. We're seeing things happen like, open houses. We're getting just a handful of people coming through. Just a couple months ago, it was standing room only. And most of the people are showing up in the first 2 or 3 days once that house goes for sale, freshly listed, and then crickets, things are dropping off. So big change. Sellers are starting to panic a little bit. I want to talk about Moody's, their chief economist, and some of the things that he has to say.
According to Moody's chief economist, Mark Zandi, he says if we enter a recession, we could see 5 to 10% national price declines.
And we've already seen that the median home sale price has dropped $10,000, according to the National Association of Realtors chief economist, Lawrence Yun.
So with this being said, Zandi believes that the market won't bottom out for another 12 to 18 months.
We'll show you here on the screen right now that Moody's actually published a map of the U.S. and they're saying that the second quarter really changed from the first quarter of this year, that out of 413 major U.S. markets, 210 of those are overvalued by more than 25%.
These 210 significantly overvalued housing markets include places like Boise, which is overvalued by 72%. Next, we have Charlotte, overvalued by 66%, Austin, overvalued by 61%, Las Vegas, overvalued by 59%, and Phoenix is overvalued by 57%.
So a lot of this has been fueled over the last 2 years. Obviously, there's been a lack of inventory and a lot of fear missing out amongst the buyers that are overpaying. The prices were continually jacked up. More and more as the market continued to climb. But really what we've seen now with interest rates hovering right about 6.5% for a 30-year mortgage, this has really drastically changed the buying power of our home buyers and, knocked a lot of people out of the market. So the sellers really have to determine, what are they going to do? Are they going to sit on the market, take their house off the market, or as inventory is starting to grow now nationwide, are they going to reduce the price, which is exactly what we're starting to see. And a lot of the comments that are coming in, guys, and we appreciate your comments. Feel free, let us know where you are. Tell us what you're seeing in your neighborhood. But we know if you just go to Zillow or Realtor.com, you can see a large percentage, sometimes 30-40% of the houses that are listed for sale have experienced some type of price decline. And, but we're still hearing that that's not enough. We hear things like they need to be in half price, 50% off. I don't think that's going to happen. I'm sticking with my numbers, Melissa. We've talked about this. I'm saying that we're going to see anywhere from a 10 to 20% price decline, 10% overall nationally. And then some of the hotter markets that really went up very fast and hard, like your Phoenix, your Las Vegas markets, Florida. I think that we might see things maybe in Nashville even come down more, 15, maybe 20%. But like Melissa said, Zandi said that, we should expect that in the next 12 to 18 months. Now, the important thing here is that when we saw the housing crash of 2008, it really started in 2005. So it took 3 years to bottom out. But hey, right now we've got more of an information highway, with the internet and all the real estate sites, things like the YouTube, right? What you're hearing right now, things kind of go a little bit faster today than they did, 10 or 15 years ago. So what I'm thinking is that Zandi's probably right. We'll probably see the market bottom out somewhere around that 12 to 18 months. And then, we'll probably start to see it increase again.
So let's talk about the economy. We know the Fed is meeting next week and the inflation is still on the rise. And where is that going?
Yeah, Consumer Price Index has said that our rate of inflation is over 8%. Certainly that's disappointing. The New York Times actually published an article yesterday where they were talking about some key things like, the Biden's Inflation Reduction Plan, that these numbers really hurt that, or at least that positive momentum, and that the Fed is really going to have to make a decision here next week. We're going to know on the 21st when Jerome Powell announces what's going to happen. A lot of the economists believe that we're going to see another 0.75 of a point increase. I have a tendency to agree with them. I think that though we've seen fuel prices, gasoline primarily, come down over the last several, maybe 9 weeks or so, it has not impacted the cost of products. So sitting over 8.2, I think, 8.1, 8.2% inflation, still extremely high inflation, the highest that we've seen in decades. And, we're really feeling it at the grocery store. So I think the Fed is going to raise rates. The 30-year mortgage, like I said, sitting at 6.5%. I think we're going to see where what I predicted as rates 7 to 8%. I think that's more realistic than not. And I think that's where we're headed.
The Department of Labor has reported that the rents have been up. They've been skyrocketing and really unaffordable for many Americans.
Yeah, 6.7% rent over last year, increase over last year's prices, and that's on a national average. These are one of the things that the economists are saying will not be affected despite inflation coming down. There's the prediction that rents are going to continue to rise. 6.7% on a national level, by the way, that's the highest rate of increase year over year since the 1980s on rental properties. Over the last 3 months, they've continued to go up 2.2% nationwide. So we're seeing that. A lot of people they're saying, hey, look, do I renew my lease? Do I go month to month?
Right.
And a lot of landlords are taking advantage of the situation, and they're really sticking it to the tenants, in my opinion. I mean, I get it. If you have somebody that's been paying the rent on time and they're good tenants, try and help them out, not hurt them by socking it to them on their renewals.
Also in the news, big cuts, massive layoffs. You've got huge companies. You have Ford, then you've got Goldman Sachs, who made a recent announcement. They're the first Wall Street company to, move in that forward progression of layoffs.
Yeah, and it's no surprise. I mean, Jerome Powell said when he had his Jackson Hole meeting on, I think it was the 24th or 26th of August, he spoke about how we could expect, as they're trying to slow down the rate of inflation, that we could expect some higher unemployment across the country. And I think he said something to the effect of, we're going to feel some type of pain as a result. So, what was happening is, labor markets were tight. Companies, I mean, there's no question, they were struggling to hire people. So they were giving sign-on bonuses, retention bonuses, paying more money to prevent them from going somewhere else when they needed the workers. But as we start to see a slowdown in the economy, a lot of industries, not all, but many industries will feel the pain more than others. And so these, layoff rounds, I think, are just the beginning. I think that we need to be prepared as to whether, before you jump in to buying a house, you have to think about, is your job stable? Because these are big concerns. And it's a big concern being in the real estate business that a lot of people stretched themselves over the last 2 years. They have bought houses, used up their cash. So for many, a layoff could be catastrophic because it's doubtful unless we start seeing stimulus from the government to sort of stipend the unemployment rate. It's probably unemployment is not a valid solution for people to pay all their bills, especially paying high grocery bills. Automation is a big thing. I can't tell you enough, guys. If you have a job, be grateful you have a job and really dive into customer service and help your business, the company that you work for, succeed. You don't want to be one of those that your boss is looking at as someone that should get cut. So definitely, I think we're going to see unemployment on the rise. Check out this link on the website, that layoffs.fyi. It's something that I discovered. It's pretty cool. It tells you who's laying off. Most of these are startup companies and tech companies, which is really under attack with this round of layoffs.
Lots of information, guys. And, if you're house hunting, lots to think about. Pay attention to the layoffs coming, especially if you're going to be purchasing a home. And we'll know next week. We're going to hear from the Fed and the direction on which we're going.
All right, guys. And if you are house hunting, you're looking for an agent, you're not in Maryland, reach out. I have a broker network all over the country. I'd be glad to connect you to a really experienced, well-knowledgeable, excellent negotiator in your town. And until next time, we'll see you soon.
See you soon.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.